Picture this. You are fully invested, you feel responsible, you did the long-term thing, and then the market drops 50%. Not in a day, not as a headline you can ignore, but week after week, your account looks like it got cut in half. The question that matters is not what you should buy next. The question is, do you even have a plan that survives a drawdown? A drawdown meaning the peak to trough decline in your capital before you get a chance to recover. Most people study returns. I study drawdowns. Returns are the reward. Drawdowns are the price of admission. The market does not send you a bill up front. It sends it later, when your confidence is highest and your risk controls are weakest. If you want to learn from history, you start with the moments that broke people, because those moments reveal the real rules of the game. Take 1929 into the early 1930s. The crash is famous. The recovery path is what teaches risk. The U.S. market did not just drop and bounce. It fell, rallied, fell again. That matters because the mind anchors. It grabs the first rebound and says, it is over. That is behavioral finance in plain English. Your brain wants closure, so it treats a temporary relief rally as a permanent fix. Many investors ran out of emotional capital, the ability to stick with a plan, before they ran out of money. That is a hidden form of risk. If your process cannot be followed under stress, it is not a process. It is a fair weather story. Now jump to Japan after 1989. The Nikkei peaked and then entered a multi-decade drawdown. This is the case study that destroys the lazy belief that markets always come back quickly. The base rate, meaning the historical frequency of outcomes, is not a guarantee. The base rate says recoveries can take a long time, and sometimes the recovery is not in your lifetime if you bought at the wrong valuation. Valuation is not timing, but it is gravity. When you pay too much, you borrow returns from the future. The future then hands you a drawdown invoice. If you want a more modern gut check, look at 2000 to 2002, the dot-com bust. The Nasdaq fell roughly 80% from peak to trough. That is not a normal correction. That is a regime shift, meaning the market rules changed because expectations and liquidity changed. Liquidity is the ease of buying and selling without moving price. In bubbles, liquidity feels infinite until it is not. In 2000, many great companies survived, but the index level was still crushed because the starting price assumed perfection. Recovery required both time and earnings growth. A big lesson here is that a drawdown can be caused by fundamentals, by price paid, and by crowd psychology, all at once. Then 2008 hits, the global financial crisis. The S&P 500 fell about 57% peak to trough. The scary part was not just the decline, it was the uncertainty around the plumbing. Plumbing means the system that clears trades, funds collateral, and keeps credit flowing. When the plumbing is questioned, correlations go to 1. Correlation is how much assets move together. In a crisis, things you thought were diversified can drop together. That is why diversification, meaning spreading risk across different return drivers, has to be real diversification, not 10 versions of the same bet. This is where I bring up leverage. Leverage is borrowed money or embedded exposure that magnifies gains and losses. Leverage turns a drawdown into a margin call. A margin call is forced selling because you no longer meet collateral requirements. Forced selling is the enemy of recovery because it locks in losses at the worst time. Long-term capital management in 1998 is the cleanest lesson. They had brilliant models and small expected edges. Expected value is the average outcome if you could repeat the trade many times. The problem was they applied huge leverage to small edges. Then spreads moved against them, volatility rose, and liquidity vanished. Volatility is how much prices swing. Their positions became impossible to unwind without moving the market. The trade may have been intellectually right in the long run, but they did not have the balance sheet to stay alive. Survival beat intelligence. A different kind of drawdown is the one you cause internally. Barings Bank and Nick Leeson is not a market history lesson, it is a controls lesson. A single trader built hidden positions and hid losses. The failure mode was not just bad trading, it was weak segregation of duties, weak oversight, and incentives that rewarded apparent profit without verifying risk. Incentives matter because people respond to what gets rewarded. If the system rewards short-term gains and ignores tail risk meaning rare extreme losses, the organization will eventually collect a rare extreme loss. That is not moral judgment, that is a statistical outcome. So what do I actually learn from historical drawdowns and recoveries? First, drawdowns are not symmetrical. The math is cruel. If you lose 50%, you need 100% gain to get back to even. That is why position sizing, meaning how much you allocate to a bet, is not a detail. It is the core. People love to talk about what to buy. The more important question is, how much can I lose and still function? Second, time is not a risk control by itself. People say if you wait long enough, you will be fine. Sometimes you will, sometimes you will not. Japan is the reminder. Also, your personal timeline matters. If you are drawing income from the portfolio, sequence of returns risk shows up. Sequence of returns risk means the order of gains and losses matters when you are withdrawing, because early losses shrink the base you are withdrawing from. A retiree with the same average return as a younger saver can have a very different outcome because the path was different. Third, volatility is not the only risk. Volatility is visible. It is the wiggle. The deeper risk is permanent loss of capital, meaning you never recover because the asset goes to zero, or because you sold at the bottom, or because inflation and opportunity cost ate the recovery. Inflation is the loss of purchasing power. A portfolio can recover in nominal dollars and still fail in real life. Real life is groceries, rent, and time. Fourth, many recoveries are driven by a few extreme days. Miss them, and your long-term return collapses. That is why trying to sidestep every drawdown with perfect timing is so hard. The decision under uncertainty is not, can I predict the bottom? It is, can I build a plan that does not require perfect prediction? This is where I think about convexity. Convexity means you benefit more from being right than you lose from being wrong, like owning an option where downside is limited and upside can be large. Most investors do not have convexity. They have linear exposure, meaning you lose and gain in roughly equal proportions. So your protection has to come from sizing, diversification, and liquidity, not from fantasies of precision. Fifth, behavior is the multiplier. In 2008, plenty of people had reasonable portfolios. Then they changed the plan at the worst time. They sold after the crash and waited for clarity. Clarity arrived after prices rose. That is the classic pattern. Loss aversion, meaning losses hurt about twice as much as gains feel good, pushes people to sell low. Recency bias, meaning you overweight what just happened, convinces you the fall will never end. And social proof, meaning you copy the crowd, makes you feel safe doing the wrong thing because everyone else is doing it too. When I look at investors like Warren Buffett and Charlie Munger, I do not see magic forecasts. I see temperament and structure. Temperament is emotional stability under stress. Structure is the ability to hold through drawdowns because you are not forced to sell. Buffett has talked publicly about holding cash and avoiding leverage. Cash is not dead money. Cash is an option on future opportunity. It reduces risk of ruin. Risk of ruin means the probability you lose so much you cannot recover. If you avoid ruin, you get to play the next hand. On the trading side, think about people like Paul Tudor Jones and Stanley Druckenmiller. I do not copy their trades. I study their respect for risk. Great macro traders survive by cutting losses, by staying liquid, and by adapting when the regime changes. Adaptation matters because the market is reflexive. Reflexivity means prices can change fundamentals by changing behavior, like rising prices attracting more buyers, which pushes prices higher until it breaks. Bubbles are reflexivity on the way up. Crashes are reflexivity on the way down. Ray Dalio has spoken a lot about diversification across economic environments. The idea is simple. You do not know the future, so you spread exposure across different drivers, growth, inflation, deflation, and liquidity conditions. You will not nail the top, you will not nail the bottom. You aim to be robust. Robust means you can take hits and keep operating. I also think about the Kelly criterion, but carefully. Kelly is a sizing formula that maximizes long-run growth given an edge. The problem is that it assumes you know your edge and your odds. In real markets, you often do not. Estimation error, meaning your inputs are wrong, can turn Kelly into overbetting. Overbetting is the fastest route to a career-ending drawdown. So I treat Kelly as a warning label. It tells me that sizing matters more than conviction, and that even good bets can kill you if you bet too big. Recovery is not just waiting. Recovery is what you do during the drawdown. If you rebalance, meaning you trim what went up and add to what went down according to a preset plan, you are forcing yourself to buy low and sell high. That sounds simple. It is psychologically hard. If you dollar cost average, meaning you invest a fixed amount on a schedule, you reduce the risk of investing everything at the peak. If you keep an emergency fund, you reduce the chance you liquidate investments to pay bills at the bottom. Those are boring tools. Boring is good. Boring survives. There is also a hard truth. Some drawdowns are telling you something real. A company can be a value trap. A value trap is a stock that looks cheap but keeps getting cheaper because the business is deteriorating. A strategy can stop working. A strategy is not a law of nature.